In this session, we'll cover cash flow statement. So, understanding the cash flow statement. So, in the last two sessions, we have covered balance sheet, income statement, and now we are at cash flow statement, which is also one of the most important parameters or one of the important concepts that you need to understand. Again, let's start with the same question: why we need to analyze or understand the cash flow statement. So basically, this statement tells you how much cash went into the business and out of the business during a specific period. It can be quarter, it can be annual. But you may wonder, like, what is the need for this statement? Because it sounds very similar to an income statement, right? Profit and loss statement, where the income, expenses, net profit. So income is coming in, expenses are going out. It sounds more or less like profit and loss statement. So why there is a need for another statement, which is cash flow statement? So if a company makes money, it makes money. So why two statements are required? This is because there is something called as accrual accounting. So this is how accrual accounting works. So companies record sales when a service or a good is provided to the buyer, regardless of whether the buyer is paying for the product or not. Whether the cash is received or not is not the question. As long as the company is certain, reasonably certain, that eventually the buyer will pay the bill, then the company can post the sale to its income statement. So if the product or the service is delivered, company can book profits, book income, book expenses, irrespective of whether the real cash came in or not. So that is called as accrual accounting. And I'll give you a simple example so that you can understand how this accrual accounting works. So let's suppose there is a business which does all cash purchase of, let's say, 80,000 rupees. Let's say there is a business. The businessman went to the supplier, bought 80,000 rupees worth of raw material and paid in cash. Everything is happening here in cash. And then he took that raw material, he converted that raw material into a finished product. Let's say inventory. So now he is selling that inventory for how much? 1 lakh rupees. And that is a cash sale. So he received 1 lakh rupees cash. Now what would be the profit? 1 lakh sale price, 80,000 rupees expense, 20,000 rupees is the net, is the profit before tax, which happened in cash. The business would be able to touch that cash as the money has already come in. Now think of a different situation. Now here the businessman went to a supplier, bought 80,000 rupees worth of raw material, paid cash. So it's a cash purchase. Whereas he converted that into a finished product and he sold for 1 lakh rupees. But the customer said, I'll pay you in 10 days. You gave the product, you delivered the product, but the customer said, I'll pay you in 10 days. This is called as credit sale. Cash is not yet received. But according to the accrual accounting, you can still book the profits, book the income. You can show 1 lakh rupees as revenues, 80,000 rupees as expenses, 20,000 rupees profits on your income statement. Why? You didn't receive cash, but still you can do it because of accrual accounting. That is what accrual accounting says. Irrespective of whether you receive the cash or not, you can book the moment you deliver the product and you are certain that he will eventually pay. So in the absence of cash, while there may be profits, there would be more paper profits, not the real profits. What if eventually the customer won't pay or may not be in a situation to pay? Then you have to write off all your 1 lakh sales is gone, 80,000 your raw material cost is gone, whatever 20,000 profits you mentioned, that is also gone. So in the absence of cash, there will be profits, but they are more or less paper profits. Now let's try to understand. Let's get a little deeper here. Now let's add few more details. Let's take Colgate as an example here. So Colgate delivered few cases of toothpaste to a general store for 1 lakh rupees. 1 lakh rupee worth of toothpaste they send to a general store. Date is very important here. On Feb 20th. So that is the date. On that date, they send the toothpaste, but gives him 60 days to pay because he is a regular customer and has a good track record of paying the bills on time. So Colgate delivered the products on Feb 20, gave 60 days time, that is 2 months of time. In 2 months you pay, that is the time they provided because of the track record. But exactly 40 days later, March 31st rolls around. What is March 31st? End of the financial year, end of that quarter also. So generally company close books, every company in India close their books on March 31st. But the Colgate booked this income, this profit on Feb 20 itself. Even though they didn't receive cash. Why? Because of accrual accounting, they are very sure that this general store will pay him back that 1 lakh rupee. So in their books, what they'll show is Colgate will show 1 lakh rupees in sales on its income statement because they delivered the product and they are pretty certain that the general store will pay back. But the general store didn't pay that cash. They'll show it as a separate entry on the balance sheet as accounts receivable. They'll show that 1 lakh rupee as sales. They'll make counter entry also because cash is not received on the balance sheet. There is a line item called as accounts receivable or trade receivables. In trade receivables, they will show this 1 lakh rupees. Now, as you can understand, companies can show, high growth, roaring sales growth without receiving a rupee of cash. If Colgate produces and sells toothpaste faster than its customers pay for the toothpaste, sales growth would look fantastic, even though the cash is flowing out of the door. Which is why we need a statement of cash flows also. So along with the PL and income statement, cash flows generated by a business also need to be analyzed. Because as I already said, in the absence of cash, there may be profits, but they would be more paper profits than real profits. Our job as an investor is to understand the profits generated by the company, whether they are real, whether they are paper profits. That is what we call as quality of earnings. Along with earnings growth, we want to check the quality of earnings also. So this is what happens in a business. This is how the money flows in a business. So any business requires capital to start its operations. And there are only two sources of capital, generating that capital. One, our money, that is owner's money, which is called as shareholders' money. The other is they can raise debt capital. They can borrow money and start business. So only two sources, own money, borrowed money. Own money is shareholders' money, borrowed money is nothing but bondholders' money. So these two, will provide the required capital. And of course, that will be lying in cash. So first, the business starts with cash deposits. Now the business or the management utilize that cash. First, they will invest that capital into fixed assets. Of course, they need land, building, machinery, plant, equipment, furniture, vehicles, so on and so forth. They need all these assets, long-term assets, to run their business, to manufacture something, to deliver something. They require all these fixed assets. First, they'll invest in these fixed assets. Then, once the plant, machinery, everything is ready, now they'll go out and buy the inventory also. That is the raw material also. So they'll invest in raw material. Once the raw material is, delivered, they'll start the production. So that raw material is converted into finished product, which is called as inventory. So now they have the product also. Now they'll start selling the product. Like I already said, not every sale will be cash sale. If the customer paid the cash outright, from product, the product will be converted into cash. So directly it will go to cash deposits. Whereas some sales can be credit sales also. So product or inventory will be converted into a credit sale. Now that will be shown in accounts receivable. So first it will be shown as accounts receivable. Then as and when the collection is done, the money is received, again it will go towards cash deposits. So this is one business cycle, but not completed yet. Now, once the cash, preferably we want to deploy X amount of cash, and after one cycle, we want to receive X plus cash because we want profits also. If the company is losing money, then it will be there is no point in running the business. So the expectation is if you invest 1 rupee, you expect more than 1 rupees in return. So let's assume the company made profits also. So that profits also will be lying in the cash deposits only. But there are few more transactions left. First is if the company is making profits, then they have to pay taxes. So they pay taxes, and if they have borrowed money, so they have to pay interest on that debt also. So they'll from these profits they'll pay taxes. They have any interest payments, they'll pay interest payments. And if they want to pay some dividends to shareholders, they want to enrich the shareholders, they'll pay something as dividends. So this is one full cycle, but the cycle won't stop. It continues forever as long as possible. So again the company will reinvest in more assets, more raw material, increase the capacity, increase the production. So more sales, more profit. So this cycle runs continuously forever, preferably forever. That is the expectation. So this is how the cash flows. So as you can see, initially, this is cash flow from financing activities, investing activities, operating activities. So this is how the cash flows. But let's look at this. This will be more easier for you to understand. So a cash flow statement is divided into three parts. So classified into three parts. If you can remember balance sheet also, we had three most important components: assets, liabilities, shareholders equity. Income statement also we have three most important components: sales, expenses, profits. Similarly, for cash flow statement also we have three most important components. First is operating cash flows or cash flow from operations. What exactly is this? Like I already said, the company may sell products or services. They receive cash. So that is operating activity. Business is operating, they are operating the business and generating cash. So any cash received going out or coming in for the sales of the business is shown here. So that is operating cash flows. Then comes investing cash flows. So like I already said, they can buy land, building, plant, machinery. This is not expense. Expense will be shown in the operating cash flows itself. But this is long-term investments, that whatever money they are spending it to buy some assets. We call it as capital expenditures. Now this capital expenditure, the whole objective is for long term. The machine they bought, the vehicle they bought, or the furniture they buy, land, all these assets can benefit the company for a long period of time. So these are investing cash flows. So if they are buying or utilizing the cash for any of these capital expenditures, they'll be shown in this investing cash flows. Last is financing cash flows. Here you will find only two types of transaction. One, transactions with the shareholders of the business. Two, transaction with the bondholders of the business. With shareholders, what kind of transaction does the company have? One, they can pay dividends. That is one transaction. Or they can dilute the equity. They can sell new shares and add new shareholders also. If they are diluting the equity or if they are paying dividends, that will be shown in financing cash flows. Or if they are borrowing money, if they are repaying back the money, repaying the principal amount back, it is again transaction with the bondholders. That also will be shown here. Now this is one of the most important concepts you need to understand: free cash flow. Free cash flow is nothing but, as the name suggests, it represents the amount of excess cash generated by a business without hurting the existing operations. So that is why it is called as free cash flow. So how to calculate the free cash flows? Pretty simple. Cash flow from operations minus capital expenditure will give you the free cash flow. Of course, in this particular session, we are not going to dive deep into understanding the free cash flows. But free cash flow is something that is going to help us tremendously in valuation. So to value a company, we need free cash flows. So whenever we go and cover the valuation, then you will get to know about the free cash flow in depth. But here, just understand free cash flow is that money which can be pulled out of the business without hurting the existing operations. Now, preferably we want free cash flows to be positive, cash flow from operations also to be positive. Because if a business is continuously running on negative and generating negative cash flows for years, that's a red flag. Here we have Kingfisher Airlines as an example. So if you look at, Vijay Mallya basically, so Kingfisher Airlines lost, pretty much went bankrupt. So shareholders lost a lot of money in this particular stock. But if they would have gone through the cash flow statement or whatever the process we generally follow, if they would have analyzed the stock, they would have escaped from that kind of a crash, or they would have saved their money, because the business went bankrupt or stopped operations somewhere around in 2013. But if you analyze the balance sheet, income statement, cash flow statement, it is pretty evident even 5 years before the bankruptcy itself, it is very evident that this business is not going to survive. For example, you can see from 2009 to 2013 is where they went bankrupt. But from 2009 itself, you can see cash flow from operations are negative. Net profits of the business are also negative. Like I already said, in the absence of cash, you cannot run the business. And how Kingfish Airlines at least survived during that period? Basically, the airline was borrowing money to pay interest, because it's a loss making company. They don't have money to pay interest on previous debt. So what Mallya started doing is he started taking new debt just to pay the interest. So at a certain point, it stopped as lenders refused to pump in further cash and business did not turn positive operating cash flows even after the infusion of cash. How long does the banks also can provide you loan just to repay the interest? At some point, banks said we can't do it anymore. Now you pay our interest and pay our principal amount back, and that's when pretty much Vijay Mallya went out of India. So how long can you run a business without turning the cash flows into positive? So as long as he was able to borrow money, he survived because on borrowed funds. But at some point, that borrowing will stop. That's when the real problem starts. So whenever a business is expanding, if you want to generate high growth, you have to expand the business. You have to invest on land, building, plant, machinery, all these things you have to invest, because if you don't expand the business, if you don't reinvest in the business, there won't be any growth. But to expand the business, you need money. And like I already said, you can borrow money and can expand. That is one way. Or the business can generate internal cash flows through profits. If the business generate profits, that's additional cash flows for the business, right? So from that cash reserves, they can reinvest. Which is best? Obviously through internal accruals. So internal cash generating capacity, through that if the business can grow, that's great. Generally we kind of look for companies where the business generates cash for reinvestment instead of going out and borrowing money and expanding. So that's what Munger also kind of mentioned, like generally avoid companies with lot of debt. High growth companies through external funding, that is through debt, generally we avoid them. Now let's look at the template. So first, as you can see, it is cash flow from operating activities. There are so many line items. So in general, you don't need to go through each and every line item. So first you can see here cash generated from operating activities. So just if you look at that number in this, as you can see 6,064 crores in 2018. 5,185 in 2017. So what we want to know is, whenever we are analyzing the cash flow statement, first thing we want to know is whether the cash is coming into the business or whether it is going out of the business. That is basically cash flow analysis. We want to know whether the cash is coming in or it is going out. So here you can see clearly the cash is coming into the business, which is a positive sign. Next, investing activities. Out of all the line items that we have, the most important line item in the investing activities is how much they are spending on capex. So purchase of property, plant, equipment, sale of the same assets. So as you can see, 888 crores is utilized for purchasing the assets. They sold some assets and generated 17 crores, and they have purchased some intangible assets also. So overall, if you look at this number, somewhere around close to 900, round figure, if you look at round figure, close to 900 or 890 is what they have spent on capex. How much cash they have generated? 6,000 crores. Out of 6,000 crores, some 900 or something cash they have utilized for further growth, that is capex. Next we have is cash flow from financing activities. Here you can see dividends paid, dividend distribution tax paid. If you look at that amount, 3,800 plus close to 700, so it is close to 4,600 or 4,500 something. So they generated 6,000 crores. Out of that, close to 1,000 crores is utilized for expansion. Remaining 4,600 something is utilized for paying dividends. So what is dividends? That money is received by the shareholders. So that is how they are utilizing. So these are the three activities you can see: operating activity, investing activity, and financing activity. But again, this is not analysis, right? This is just reading the numbers. So if you look at 5 years of data here, each year cash flows are positive. So generally, whenever we are looking at a business, this is the kind of business we like: positive cash flows. And there is one more thing called as you can see here, net cash from operating activities. So here the numerator is basically the sales. So if you take 100% as revenues, and out of 100% revenues, for example, here you can see 6,000 crores. So company sales is 35,500 crores. Out of that 35,000 something crores, 6,000 crores is generated as cash. So which is 17%. So as long as this ratio is more than 5%, it is great. Of course, I'll cover about this ratio going forward also. When we do it practically, I'll show you. But here, just remember, we want this cash flows as a percentage to sales, a minimum of 5%. So if the company is generating at least 100 rupees in sales, the owner of the business should be able to put at least 5 rupees in his pocket. So of course, we use free cash flows for that, but cash flow from operations also needs to be positive and should be a big number. So here 17% is good. And you can see capex 895, 1400, 800, 600. So this is what every year they are utilizing the fund, how much funds they are utilizing for capex. And we have dividends paid also. You can see here, all these are dividends. And final free cash flow. Free cash flow is nothing but this 6,000 crores minus this 900 crores is free cash flows. So 5,186 crores is free cash flow. That money they can take out of the business because already 900 crores is invested for further operations or further expansion. So this 5,000 crores is not required by the business itself. It is not required. The company can do whatever they want. If they want to, they can buy other business. They can give it out as dividends. They can do whatever they want. And in this 5 years, if you add up all these numbers, 3 plus 5, 8, 11, so close to 16, 17,000 crores of free cash flow this business generated. And free cash flow to sales. So this is what I wanted to cover. So free cash flow to sales, I mean generally we want it as 5%, minimum 5%. Why? This is the cash generating capacity of the business. So, like I already said, for 100 rupees sales, at least 5 rupees the owner should be able to put it in his pocket. So, free cash flow is something that is obviously this is the money they can pull out without hurting the business. So, at least 5 rupees the owner should be able to take his home. And here in this business or this example, you can see consistently it is more than 5%, which is great. Now, these are the most important questions I want to ask whenever I am looking at a cash flow statement. Question number one: what are the major sources of cash? So, in this example, you can see every year cash flow from operations are positive. So, here you can see blue, that is operation. So, every year cash flow from operations is blue and that is positive. So, the major source of cash for this business is cash flow from operating activities. That is the major source of cash. Next, what are the major uses of cash? So, uses only we will get to know when we look at the investing activities. So, here you can see they are buying and they are investing some money in FDs. They are making some investments also, most probably mutual fund investments they are making, and of course they are investing for further growth also, which is capex. So that is what the business is doing. Relationship between net profit and cash flows, this is very important. This is one of the most important aspects. So here you can see net profits of the business are consistently positive, cash flow from operations are also positive, and you can see the graph 5 years and 10 years. So they won't be equal, but we want them aligned with each other. So we want cash flow statement and income statement to narrate the same story, not different stories. So here both operations are also positive, net profits are also positive. So basically they are consistent with each other. Net profit, income statement and cash flow statement is basically narrating the same story, and it is positive. That is what we want. And in fact, in most of the years, green is bigger than blue. That is, the cash generated is actually bigger than the reported net profits. Next, is cash flow from operations sufficient to cover capex? Why this question is asked? Because if it is not sufficient, then to cover the capex, the company will go out and borrow money, like Kingfisher Airlines. We don't want that kind of a situation. With this company, you can see the capex is, let's say, 900 crores. How much cash is generated? 6,000 crores of cash is generated. So for this business, external funding is not required. So within the whatever the cash generated within the business is more than enough. So this company can cover capex without going for external funding. And for such companies, free cash flows will be positive. They have excess cash. So yes, they can cover capex. Next, other than capex, is cash being used or generated in investing activities? Yes. If you look here, they are purchasing some investments, they are doing some bank deposits also. This is also very important. Types of financing cash flows. So in this example, you can see dividends paid. Out of all the cash flows, dividends paid is 4,600, 700 crores. Here also it is like 4,200, close to 4,000, 3,500. So as you can see, majority of financing cash flows is dividends. So the company is generating a lot of cash, and most of it is actually given out for as dividends for shareholders. Now that is company 1, let's say. Now let's look at company 2, the reverse situation. Companies that we generally avoid. These are the kind of companies. So here you can see consistently every year, except for this year, every year the cash flows are negative. So here the cash is not coming into the business. In fact, cash is going out of the business, which is not the ideal situation. Next, as you can see here, they are spending some money as capex. But the question is 2,000, 3,000, 4,000, 5,000, 7,000. But the question is, when the cash flows are negative, how they are able to invest in capex? Because they are not generating cash, right? How? Here you can see consistently they are borrowing a lot of money, 12,000, 700 crores, 5,000, 10,000, 11,000, 17,000. So in this 5 years itself, some 55,000 crores they have borrowed. So for this company, things are very different, right? Even if you look at free cash flows is also consistently negative. So company one generated 15,000, 16,000 crores of free cash flows in 5 years. Whereas company two, you can see, if you add up all these numbers, it's like 11, 7, 18, 24, 28, 30. So close to 35,000 crores of negative cash flows, negative free cash flows. That much money is going out of the business, not coming in. Free cash flow to sales, generally we want this number to be positive 5%. Positive, first we want it as positive. How much positive? 5%. But here you can see consistently negative numbers. Now let's ask the same questions here also. What is the major source of cash? With company one, it is completely blue, operations. With company two, is you can see here financing activities, red, red, red. Even last 10 years also, this company is generating cash flows majorly through financing activities. As you can see, financing activities. So borrowing a lot of money and surviving. Next, and one more thing, if you ask me like what is the ideal situation, there is three classifications, right? Ideal situation, I want cash flow from operations to be positive. To be positive. Investing should be negative. Financing also, I want cash flows to be negative. Why? Because I want the business to sell more products, sell more services, and generate operating cash flows, positive operating cash flows. Once they get the cash, I want the business to grow. So I want money to go out into assets, long-term assets. So if the money is going out, the investing activities will be negative. Let the money go out because that money will bring in more money in future. And financing activity, I don't want debt. I'm okay with dividends. So here also I want negative cash flows only. So money should go out for shareholders as dividends or whatever, but I don't want money to come in from financing activities either through additional equity, raising debt, or selling equity and raising capital. I don't want those activities. So ideal situation here, it should be positive, these two should be negative, which was the case with the first company. All positive, here negative. But this company 2, as you can see here, is reverse. This company is borrowing a lot of money and utilizing some money for investments and running the business. Next, major uses of cash. So here you can see, along with capex, they are buying and selling some mutual funds, they are investing in some FDs also, and here you can see they are generating some dividend income also. So they might be investing in mutual funds, liquid funds, FDs and all. So that is along with the capex. Most important question, relationship between net profit and CFFO, that is cash flow from operations. You can clearly see this company is consistently reporting net profits, positive net profits. But when it comes to cash flows are negative. So income statement is narrating a different story, cash flow statement is narrating a different story. So as you can see here, blue is positive, which is net profits. Green is negative. Even last year, 10 years data is also kind of narrating the same story. So this is the reason why this company cannot afford to pay dividends. When the cash flow from operations itself is negative consistently, then why this company is paying dividends? 2000, 3000, 4, sorry, here dividends, 2300 crores as dividends, 2000 crores, 1800. Why this company is paying dividends? Because it clearly cannot afford to pay dividends, right? It's because of this. It is consistently posting positive net profits from 2000 crores to almost 8500 crores in that 10-year period. So that's a massive growth. Shareholders, media, generally everyone only cares about earnings growth, sales growth, net profit growth. They only care about that. No one checks what's happening in the cash flow statement. So if this company is not paying dividends, then everyone would question, like, you are making so much of profits, then why you are not paying dividends will be the question. So to avoid that question, they consistently paid dividends even though they cannot afford to pay them. They borrowed money and paid dividends. So that is the situation. So if you look at the relationship, cash flow statement is narrating a different story, income statement is narrating a different story. CFFO, whether the cash flows from operations is sufficient to cover the capex? No, cash flow from operations itself is negative. This company is not generating, didn't generate any cash. So to cover the capex, they borrowed money. And of course, free cash flows are also negative. Other than capex, cash is being used. Yes, they are investing in capex, they are investing in some mutual funds, they generate some dividend income, they are investing in some FDs also, some liquid funds also. So they are doing that. Types of financing cash flows. Company 1, complete dividends. Company 2, all borrowings. You can see interest paid, proceeds. This is basically diluting the equity. And here you can see increase or decrease in debt. So consistently every year company is borrowing money. So we don't want borrowings, we want dividends. But here the case is, reverse. So the bottom line is, cash flow statement basically records all the cash that comes into the business, all the cash that goes out. And as a shareholder, our preference is we want cash to come into the business than to go out. Of course, cash will go out, but the cash that comes in should be bigger. So that is what we generally expect from any business. And now let's look at one of recent examples also. Let's look at, for example, Gulf Oil, one of our recommended stock. So if you look at Gulf Oil lubricants, this is the cash flow statement. Of course, you'll find many line items, but not required. For example, if you look at first section will be cash flow from operating activities 25, 24, 2 years of data you'll find. And if you slightly scroll down, this is where you will find cash flow from operating activities. So it is in lakhs. So we have to convert. So basically this is 341 crores last year, 395 crores this year. So question number 1, whether the cash is coming in or going out. Clearly 395, 340. So cash is coming in. That's a good news. And if you look at the capex also, you can see here 53 crores buying plant machinery and all. Last year 27 crores. They sold uh, some assets also. So as you can see, this is the capex. These two line items are basically capex, and here also you can see acquisition of a subsidiary. They utilized 40 crores and they acquired a subsidiary also, which is also expansion of business, which is also considered as capex only. So as you can see, these are the three line items where you will find the capex of the business. They generated 395 crores, utilized close to 40 odd crores for capex. What about the remaining? So they paid 196 crores as dividends paid. And of course, they have some lease liabilities also. So they paid some short-term borrowings also. They raised some short-term borrowings. But chalo, if you look at the debt to equity ratio for this company, it is 0.3. So overall debt to equity ratio is in the reasonable range. But of course, here also the biggest number, if you look at all the line items, the biggest number is dividends only. 196 crores here, 200 crores last year. So last year they paid 200 crores. This year also they paid close to 200 crores dividends. So this company is also paying a lot of dividends. 10 years of data for Gulf Oil lubricants. Consistently, you can see here, every year this business is consistently generating cash. And over the last 10 years, 1830 crores of cash is generated. And out of that 1800, close to, so almost 1258 crores of free cash flows are also generated. So cash is coming in and free cash flows are also positive, which is great news. Again, let's ask the same questions here. What are the major sources of cash? So as you can see, blue, cash flow from operations, that is the major source of cash. Whether cash flows from operations is sufficient to cover the capex, you can see the capex is here. And of course, cash flow from operating activities is bigger than free cash flows, bigger than capex. That is the reason free cash flows are also positive. So yes, relationship between net profits and cash flow from operations. So as you can see, again, in line with each other, net profits are also positive, cash flows are also positive. So they are in line with each other. It's not like net profits are extremely positive and every year cash flows are negative. That is not the case. So with this company, even with Gulf Oil also, cash flow statement and income statement is narrating more or less the same story. So that is cash flow statement analysis.